Welcome to All About Income Statements. Upon completion of this training, you will be able to explain the purpose of an income statement in evaluating the profitability and financial health of a farming operation. Identify and differentiate between the key components of an income statement, including revenue, expenses, accrual adjustments, and depreciation. Explain how accrual adjustments contribute to a more accurate representation of a farm's profitability by accounting for changes in short-term accounts. Describe the impact of depreciation on machinery, vehicles, buildings, and improvements, and understand why it is considered a real expense in financial statements. An income statement, sometimes called an earnings statement or a profit and loss statement, records revenue and expenses for a period of time, typically a year. The income statement shows if your farm is profitable and helps determine an operation's expansion potential. In addition, it also helps evaluate the profitability of an enterprise and assists in loan repayment analysis. Whereas a balance sheet reports assets, liabilities, and equity, an income statement reports the revenue and expenses that determine a profit or loss. This allows you to determine if you've generated enough return on your investments of time, money, and labor. Now that you understand the purpose of an income statement, let's look at the components: revenue, expenses, accrual adjustments, and depreciation. The first component is revenue or income. This includes all cash payments received for farm products, income from livestock or custom work, as well as government payments and crop insurance payments. Revenue does not include the sale of land, machinery, or other capital assets. The second component is expenses. This category includes all regular operating expenses, such as feed, labor, real estate taxes, and interest paid on farm debts. Expenses do not include purchase of land, machinery, or other capital assets, income tax, or Social Security payments. The third component of an income statement is accrual adjustments. If you're using a cash accounting system, you'll need to make some accrual adjustments to get a true picture of your farm's profitability. Adjustments should be made for inventory, accounts receivable, value of growing crops, prepaid expenses and supplies, and accounts payable. The last component of an income statement is depreciation. Your income statement should account for depreciation on your machinery, vehicles, buildings, and improvements. While these are not cash expenses you would see in your bank account, depreciation is a real cost to your operation. Eventually, most of your assets will need to be replaced to keep your farm operating. Due depreciation is an expense that must be accounted for. Revenue and expenses may be relatively straightforward, but accrual adjustments and depreciation are a little more complicated. Let's look at this in more detail. Accrual adjustments help to outline an operation's actual profitability per fiscal year by accounting for changes in short-term accounts like inventory, market livestock, and prepaid expenses. For example, accrual takes into account any fluctuations in income and expenses from fertilizer purchased in one year but used in the next, or delaying the receipt of a grain check until January for tax purposes. Accrual income statements allow for that grain inventory to be included as income in the year it was produced, not the year it was sold. It's important to remember that depreciation you see on your taxes may not be the same as the depreciation you will use on your income statement. To determine your annual depreciation, follow this simple rule of thumb. Use 15% of market value for all machinery and titled vehicles, and 5% of market value for farm buildings. Let's look at a sample income statement for examples of things that might be included in each section. Let's look at a sample income statement for examples of things that might be included in each section. Each farm will have unique data, but examples show how the sections are related. The first section shows your total income, and the second section totals the expenses. Cash farm income is determined by subtracting total expenses from gross revenue. This figure shows you the income generated from typical day-to-day operations. The third section, accrual adjustments, is totaled and subtracted from net income to determine net operating profit. The fourth section shows total depreciation followed by capital adjustments. which is where you will account for any purchases or sales made outside of the day-to-day operating revenue and expenses. Subtract total depreciation and add capital adjustments from your net operating profit to determine your net farm income, or NFI. You will use the information in these 4 sections to determine your operations profitability. Being profitable means generating enough return on your investment of money, time, and labor. There are 3 basic calculations that can help assess your operations profitability. The first calculation is net farm income from operations, or NFIFO. NFIFO is calculated by subtracting expenses from accrual adjusted gross revenue. This figure shows you the income generated from typical day-to-day operations. In the sample income statement, this is listed as net cash farm income. The second calculation is capital adjustment, which you will need to calculate your net farm income. To calculate net farm income, be sure you've accurately accounted for your capital purchases and sales. For example, if you purchased $20,000 worth of capital equipment and sold $22,000 worth of equipment, your net capital changes would be $2,000. Total capital sales minus your total capital purchases, which in this example means your capital adjustment would be $2,000. The third calculation is net farm income, or NFI, which is calculated using these figures from the first 2 calculations. To calculate your net farm income, take your net farm income from operations, or NFIFO, and subtract capital purchases, then add capital sales. This allows you to account for out-of-the-ordinary sales or purchases. Now that we've discussed the components of an income statement and how to use it, let's do a quick review. An income statement and a balance sheet are basically the same. That's false. Whereas a balance sheet reports assets, liabilities, and equity, an income statement reports the revenue and expenses that determine a profit or loss. Do you remember which of these are details found in an income statement? An income statement details your revenue, expenses, accrual adjustments, and depreciation. Do you recall the equation for determining cash farm income? Cash farm income is determined by subtracting total expenses from gross revenue. This figure shows you the income generated from typical day-to-day operations. What about the equation for determining capital adjustment? Remember that to calculate your capital adjustment, you must accurately account for your capital purchases and sales. So you would subtract total capital purchases from your total capital sales to determine your capital adjustment. Thinking about depreciation, do you recall the annual depreciation for the market value of assets such as machinery and titled vehicles? That's right. Use 15% to determine depreciation for all machinery and titled vehicles. Still thinking about depreciation, true or false? As a simple rule of thumb, use 5% for depreciation of the market value for farm buildings. If you set use 5% as the typical depreciation of market value for farm buildings, you're right. The easiest way to determine depreciation is to look at last year's taxes and use that as a starting point for determining this year's depreciation. That's false. The depreciation you see on your taxes is not the same as the depreciation you will use on your income statement. Revenue includes the sale of land, machinery, or other capital assets. That's false. Revenue does not include the sale of land, machinery, or other capital assets. Lastly, what accounts for out-of-the-ordinary sales or purchases by taking the net farm income from operations and subtracting capital purchase, then adding capital sales? Net farm income will account for out-of-the-ordinary sales or purchases by taking the net farmed income from operations and subtracting capital purchase, and adding capital sales. In this training, you learned about the purpose of an income statement and how it can help you evaluate profitability and the financial health of a farm operation. You also learned about key components of the income statement, such as revenue, expenses, accrual adjustments, and depreciation. All About Income Statements also explained how accrual adjustments contribute to a more accurate representation of a farm's profitability by accounting for changes in short-term accounts, and describe the impact of depreciation on machinery, vehicles, buildings, and improvements. Now that you've learned all about income statements, you will be able to leverage what you learn from your income statement to better manage your farm operation.